If you're an Edexcel A-Level Business student looking for a video to revise all of Theme 3.4, the influences on business decisions, well, this video is for you because we're going to go through everything that you need to know for your exams, including looking at a really important theory of Handy's corporate culture. We'll also take a look at different concepts such as the stakeholder and shareholder approach, and we're also going to take a look into business ethics and CSR and so much more. Let's get into it. The first topic within this revision video that we'll take a look into will be our corporate timescales. Now, this topic basically looks at the influences that short-term pressures and long-term pressures have on our business decisions. First of all, let's take a look at this concept called short-termism. Now, it's kind of in the name. Short-termism is a business approach that wants to prioritize immediate gains over long-term sustainability and growth. And you'll typically find these short-term gains being around profit maximization, because this short-termism approach really wants to focus on how we can reward our shareholders in that short-term period. So as we said, the business wants to focus on maximizing profits within the short term. So a way a business would do this would be around cutting different costs. So a way a business could do this is by reducing the amount of training their employees receive. Also look at reducing the research and development investment to the business. And this could be really good because, as we said, by maximizing those short-term profits, our shareholders are going to be a bit happier. Maybe the dividends would begin to increase. Maybe our share price could also increase as well. However, the problem is by trying to prioritize the short term, you end up hindering your long-term growth strategy. Because if we're not training our employees as much, well, the quality in their skills will begin to go down. And as well, if we're not investing in research and development, our long-term innovative strategy may also begin to suffer. And if you're not investing into your staff, maybe the employee morale may start to go down, increasing our labour turnover rates. However, we've also got our long-termism. And as you could imagine, what the business is focusing on now is their long-term success. So we're focusing on sustained growth. We're focusing on developing real high quality profit, not just the one-off sales. We also want to prioritize more of the strategic planning and how can we create that long-term value. Now, in terms of how a business could do this, well, their decisions, as we said, will be focusing on long-term growth and profitability. So investing more into research and development and innovation. We also want to show our staff that we care for them and we want to focus on their personal development. So looking at training, maybe on the job or off the job. We could also look at focusing on market growth and, most importantly, reinvest in our profits. So rather than paying our shareholders dividends, we reinvest that profit back into the business. Now, typically from these strategies, you'll tend to find that you're more competitive over the long term. For example, with research and development and innovation, you're potentially gaining a competitive advantage through differentiation. And as well, if you show that you care more for your employees, investing in training, well, then employee morale would increase, potentially reducing those labour turnover rates. But of course, the problem with this strategy is it is going to cost you a lot more money in the short term. So you cannot expect to maximize your profits within that short term period. The next topic in this revision video that we're going to be taking a look at will be the difference between evidence-based decision making and subjective decision making. Starting off with, well, what actually is evidence-based decision making? Now, all evidence-based decision making is when we use data within our decisions. So what we want to do is we want to collect that data, we want to analyze the data, and we want to make more informed decision making based off actual evidence. And typically a business will use evidence-based decision making when there's a lot more risk involved. So for example, we could use a decision tree when trying to analyze and evaluate two different investment options, or when the business is making more strategic decisions. Now remember, what we mean by a strategic decision is one that impacts the business as a whole, which typically includes more of these long-term strategies. Now, of course, in strategic decision making, we're going to be committing a lot more resources. So making the best decision will be really important because we're going to invest so much resources that we don't want to lose. So now, what is subjective decision making, also known as intuition decision making? Well, this is when a decision is made based on gut feelings, instincts, and personal experiences rather than trying to collect data and analyze it. Now, typically when we look at subjective decision making, the risk now to make the wrong decision tends to go up because we're not basing the decision of objective data, we're now basing it off subjective feelings. Now, in terms of whether subjective decision making can be a good thing, well, it kind of depends on who's making that decision. Because if you've got one of the most successful entrepreneurs in the world, they've grown multi-billion-dollar businesses, well, you're going to tend to trust them a lot more when they make those decisions. But if you're going to hand that decision to someone who lacks experience, lacks skills, then their subjective decision-making quality will tend to be a lot less. Now, typically you would use more subjective decision-making when that data isn't available to us, which tends to be a lot of startup companies because they don't have a lot of past data to try and support future decisions. The next topic we're going to take a look at in this revision video will be all about corporate culture. Now, what do we actually mean, first of all, by corporate culture? Well, essentially, it's the shared values, beliefs, and behaviors that shape how employees interact and work within a business. You know, when we think of the term culture, you typically think of the culture of a nation or a culture of a select group of people. Now, we're applying that same principle and concept just to a business. So how is the business interacting? How are the employees interacting within the company? Now, we have two situations normally present. We have a business either with a strong culture or with a weak culture. Now, what we mean by a strong culture is that the employees, they align with the company's values. So what the company is trying to achieve, you know, depending on their mission statement, the employees, they agree with that and they want to work hard for that mission. So this would shape their behavior, work ethic, relationship, and hopefully create more of a unified workforce. So you'll typically find that employees are more motivated within a strong culture because they agree with what the company stands for. And you'll find that your employees need less supervision now because the business would tend to trust their employees more within a strong culture and they won't need to micromanage and supervise them all the time. And I think the most important factor is that these employees, they have a sense of identity, they have a sense of belonging with that culture. However, we also have situations where we have weak cultures. Now, if a strong culture is where the employees are unified, they believe in what the mission stands for, they have shared values of the company, a weak culture is completely opposite. A weak culture exists when employees do not share the company's values, typically leading to a lack of clear identity and cohesion. So there is no sense of belonging. There is poor employee engagement. You know, employees aren't really working in teams. They don't want to collaborate with one another. And they may be stuck in their own way. So what we find with a weak culture is that the employees don't want to change. So if there was external environment changes, you will tend to find with a weak culture, the employees within the business, they are fairly resistant to that change. And typically your employees aren't as happy, so labor turnover tends to increase. But we ask the question, well, how do we form a corporate culture? Now, corporate culture is formed out of several different factors. First of all, it's about the founder's vision and values. So it was the original ideas, beliefs, and goals of the founders that typically influence the company's purpose. And this would then set the standards of how employees are expected to work. We've also got any rules, procedures, and organisational structures, because this will obviously shape how, once again, work is done, how employees interact, the level of bureaucracy, and how our employees are encouraged to engage with one another. The type of product will also be massive. So for example, with a company such as Rolex, who is a luxurious watch designer, you think the culture within there is all about prestige and high quality and care for quality. Whereas a company like Audi and Lidl, the culture is very different because in a Rolex store, the environment is really car and prestigious. Whereas Audi and Lidl is a bit more chaotic. You don't have as much interaction with the workers there. We can also look at the company's past experiences, challenges, and successes because this will shape their reputation, their internal attitudes, and the way they work. We can also look at the leaders because these will be the ones who are acting as role models. They will set expectations. So are we having a leader with an autocratic style, a democratic style? We could also look at the company events, do they host any team building activities? Because this once again will influence that sense of belonging and whether the business wants to promote teamwork. Also as well, we'll look at the cultural influences from the company's home country because this would also affect workplace norms, how we communicate, the leadership approaches, and finally the values and beliefs. So any ethical standards that the business may have. Now with corporate culture, it will tend to change over time and there's a good reason for that. However, it can be quite difficult for a business to change their organisational culture. And this is because you're asking to change people's attitudes and beliefs, which can be quite a challenging thing to do. Policies, they can be changed fairly easy, but altering long-standard behaviours of employees as they've seen something as being normal is a lot harder. Even if the previous culture was unhelpful, identifying the exact aspects that need to change can be difficult. Because those employees, they may have gotten used to those attitudes and traditions and way of working, and they may be fairly resistant to change. The next topic in this revision video that we're going to take a look into will be Handy's corporate culture model. Now, in 1976, Charles Handy came up with this corporate culture model, which explains how different organisational cultures will influence the decision making happening within a company. And it categorises the businesses based on the different structure, control, and their working style. And we have 4 different corporate cultures. We have power, role, task, and person. Let's go through each of them, starting off with the power culture. Now, with the power culture, this is when the decision-making power is going to be centralised, where only a small amount of people or even one person will be making all of the key decisions within the business. So there isn't much delegation, and typically you'll find that a power culture happens when we've either got a really influential leader or within startup companies. And because only a few people will be making all of those decisions, you'll find that there's not a lot of rules or procedures in place. Now, what's important with all of these different 4 corporate cultures is that we want to identify why could it be a good thing and why could it also be a bad thing. Well, it's good because if only a few people are going to be making those decisions, so all the power just lies at the top of the organisational hierarchy, well, in times of crisis or within a dynamic market, this can be quite a good thing because the speed of decisions will be a lot quicker. Because I'm not asking all of my subordinates what they think the decision should be, because I'm approaching it more with an autocratic style where I'm going to make the decision and I'm going to tell everyone else what they need to do. So it provides a lot of clear direction for those employees. So if you have employees who have got low skill or low experience, once again, this can be quite a good thing, or within times of crisis. However, typically you'll find that the lack of employee involvement tends to decrease our motivational levels. Because you can relate to Hertzberg's 2-factor theory. Because within that power culture, we're not really focusing on job enrichment. We're not giving our employees more responsibility. We're just telling them what they need to do. And another problem is that if we did have this really influential leader who made all of the decisions in the business, well, what happens when they leave the company? This can become quite problematic because you'll tend to find the employees, they over-rely on that leader. Now, the next corporate culture that Handy identified was a role culture. Now, a role culture is a structured and a strict hierarchical system. And this is where your authority within the business will be defined by your job title. So you typically find these within these tall organisational structures, where employees will have clearly defined roles and responsibilities depending on where they are within that hierarchy. So there is a real clear chain of command. And a role culture tends to work well in larger organisations that have complex operations. Because if I've got over 10,000 employees that I need to manage, then I need to make sure that there's clear coordination and communication channels set in place. And what we mentioned earlier is that your authority is defined by your job title. So you'll tend to find more employees are able to specialise within their roles. However, the organisation becomes a bit more rigid and less flexible because it becomes more bureaucratic. And what we mean by bureaucratic is there's lots of rules, policies and procedures in place. So if we had someone who wanted to pose an idea, but it's not within their job title to do so, then this has to go through a long-winded process of passing that on to their manager, and they then pass it on to their manager. So what you may find is that decision-making becomes a lot slower. And of course, within that hierarchy, we've got more layers because we're talking about a tall organisational structure. So the vertical communication becomes a lot slower, and all the communication happens from the top flowing down of the business. And this could potentially hinder our innovation levels, because if one of those lower level employees did have a real creative idea, then the vertical communication would typically slow this down. The next one of Handy's corporate cultures is a task culture. Now, within a task culture, there's more of an emphasis on teamwork and creative solutions, because typically within this task culture, a business may have a problem or a project that they need to work on. And what they would do is they would start to form teams to try and resolve that certain problem or to try and work on a project. So whereas before with a role culture, your influence and your authority is defined by your job title, but now with a task culture, your influence comes from the skills that you have, the ability, the knowledge that you have, and how useful that you could therefore be within the team. So decision making becomes more decentralized. So rather than the people at the top of the organization having that authority, that is now passed on down to the team, and employees tend to become more motivated. This heavily links with Mayow's human relation theory, and it could also link with Maslow's hierarchy of needs, looking at our social needs. Now, a task culture tends to align with a matrix structure, and a matrix structure is an organizational framework where employees report to multiple different managers, typically both a functional manager, so as we can see there, the marketing, the IT, the finance, the sales, the operational teams, and also a project manager. Now, this structure tries to promote more collaboration across different departments, and once again is commonly used when we work on different projects. You can also apply a task culture to work in a tool or a flat organisational structure. It just depends on whether we're forming teams. Now, why is this a good thing? Well, if you're forming teams and you're decentralizing that decision-making authority, then as we said earlier, we tend to find motivation increases, linking to Mayow's human relation theory, linking to Maslow's social needs, and also linking to Hertzberg's two-factor theory with the job enrichment. And it will also encourage more innovation. That's why companies like Google tend to focus more of a task culture. And if you haven't already, make sure you have a look at some videos of the corporate culture at Google. However, the problem is that we can actually see a bit of a lack of clear authority. If you're working with employees who lack skills, who lack the knowledge, then this probably isn't the best approach to have. And what happens if the teams don't get on very well? Who then has the authority? Do we have a project manager? Do we have a team leader to try and resolve this? And another problem looking at the matrix structure is that what if I'm needed on multiple different projects all at the same time? So the level of coordination can then start to come under challenge. And the very last one of Handy's corporate cultures we have is the person culture. Now, with the person culture, this is where the business simply exists to serve the individuals that work there. So there's greater importance now on the individual rather than the organisation as a collective whole. Now, with a person culture, you don't really tend to see these as much anymore. An example could be a specific agency where the whole point of the business is just to promote their services. You could also look at professional firms as well, I think with law and accounting firms. But that doesn't mean that if you are a law firm or an accounting firm, that you are looking at a person culture. But what's important with the person culture is that all the decision making is done independently. All that authority and autonomy is passed on to the individual. So there's not really a hierarchy in place. Yeah, you may have some supervisors who support the employees, but they will be doing a lot of their work independently. Now, once again, this can be a good thing. Having that high level of autonomy, if you are a skilled worker, can start to boost your motivation, because you want to approach it more like a laissez-faire leader, that you just let the employees get on with it. Because now I have greater freedom as an employee to try different things, as there isn't much bureaucracy within that business. There's not a lot of rules or policies that I have to follow. However, that lack of direction can be quite problematic, especially if I'm a new employee, lacking skills and lacking knowledge. So I'd rather gain more experience with more clear direction. And of course, if there is a lack of a hierarchy in place, we're not putting people together in teams, then we could begin to lack that team cohesion within the business. Just a quick one, if you are looking for a bit more support with A-Level Business, whether that's improving your confidence with the content or giving you more support around your exam technique, I run a tutoring program that gives you all the support that you need for your A-Level Business exams, whether you are in year 12 or year 13, as we offer one-to-one support, small group sessions, online courses, online resources, messaging support, and so much more. If you want to apply for the tutoring program, feel free to check out the links in my bio. Back to the video. The next section now of this revision video is going to look at more of the business ethics side of things. And to start this off, we'll take a look at our shareholder versus stakeholder approach. First of all, what actually is the shareholder approach? Now, this was more of a traditional approach where businesses just simply exist to serve their shareholders. And remember, a shareholder is just an owner of the company, typically found in private and public limited businesses. Now, the way we would want to benefit those shareholders is provide them with these financial returns. And remember, a shareholder gets paid in one of two different ways. The first way is through a method called dividends. And this is where a company makes a profit and takes a portion of the company's profits and pay their shareholders. Now, of course, this is optional. It doesn't mean that if we make a profit, we have to pay our shareholders. Keep that in mind. Or the second method is called capital gains. And this is when the share price would increase from when they originally bought it. So I bought a share in Apple for $100. A few years later, I then sold it for $150. I've made a capital gains. I've made a profit of $50. So the other way is, how can the business focus on increasing the share price of the business? So whenever a business now is making a decision under the shareholder approach, they will ask themselves, will this decision benefit my shareholders? And this can start to increase the investment that the business starts to have, because if we find that a company is really focusing on paying their shareholders more dividends, has a reputation of increasing the share price value, then you'll tend to find new shareholders and new investors want to get in on the action because they'll get a bit more money. So what the business wants to do is they want to focus on profit maximization. Because of course, to pay more dividends, you need to make more profit. And to increase that share price value, once again, you want to focus on maximizing profits. Now, looking at the start of this revision video, we talked about short-termism versus long-termism. So when maximizing profits, this can be more focused on the short-term performance of the company. Now, the problem is, yes, you can make lots of profit. You can make a lot of return for your shareholders. But we ask the question, how is the company making profits? Are they doing such in an ethical way? Because a business can start to look at making profit through cost cutting. So for example, rather than manufacturing within the UK, why not offshore? Why not outsource to a business overseas where we know the labour is cheaper? We'll go into a lot more detail of that when we look at theme 4. And there's loads of other cost cutting methods such as cheaper raw materials, reducing our employee training costs, making employees redundant. And one of the biggest problems of this shareholder approach is that it lacks our long-term sustainability. But what doesn't lack our long-term sustainability is our stakeholder approach. Now, first of all, what actually is a stakeholder? A lot of students tend to think stakeholders and shareholders are the exact same thing, but they're not. A shareholder is an example of a stakeholder, because a stakeholder is an individual or group of people who have an interest within a business, or they are affected by their decisions. So a stakeholder could either be internal to the business or external. Internal to the business, your employees, you got your managers, you got your owners. External to the business, you've got your local communities, your competitors, they're a stakeholder. You've got the government, you've got your suppliers. So with the stakeholder approach, rather than our decision making just being around benefiting our shareholders, now we want to consider the interests of all the stakeholders. So not just focusing on profits. So what we want to do is we want to start communicating a lot more with our different stakeholders, with our internal ones, with our external ones. Now, I wouldn't say the stakeholder approach is trying to make decisions that benefit our competitors, but more so the ones that we want to benefit, that we want to have a good relationship with, like as I said, the local community, suppliers, the government, and so on. Now, with the stakeholder approach, you'll typically find short-term profits tend to decrease, and I'll explain why. Because let's consider a few different stakeholders and how their objectives would conflict with a shareholder objective. Starting off with our customer objectives. So how would your customer objectives, so what they want from the business, conflicts with what your shareholders want? Well, quite simply, your customers, they want the best quality products at the cheapest prices. So let's look at the quality products. Well, we know to make a high quality product, the business is going to have to increase their costs. Maybe using better quality raw materials. And of course, with cheaper prices, we need to look at reducing our prices. So both of these decisions, well, that could start to reduce the business's profitability. And we know, well, shareholders, they just want to see an increase in the business's profit so they make more money. Well, what about our employee objectives? How would they conflict with our shareholder objectives? Well, if you think for an employee, they want to be treated fairly. They want to be paid the most amount of money that they can for the jobs that they do. And of course, with employees, they want to focus on their own personal development. So when we look at the personal development, they want their business to invest into them. They want to conduct training for them, on the job, off the job training. They also want to make sure that the work environment is safe for them, is inclusive and supports employee growth. So when I look at all of this, well, this is going to increase the business's cost. What we know from the shareholder's perspective, well, if we start to increase the costs, this may start to reduce that short-term profit. And of course, that means less returns for them. But the way you could evaluate it is that if you are showing your employees that you care about them, their personal growth, their skill development, their motivation and productivity should tend to increase over the long term, which could improve the business's profitability. And finally, well, what about the conflict between the supplier objectives and the shareholder objectives? Well, from a supplier perspective, they want to be paid the most amount of money for the resources they supply the business with. And they also want favourable payment terms, so they want to be paid as soon as possible. Now we know the payment as soon as possible would tend to negatively impact our cash flow. And of course, if they want to be paid a fair price, this once again typically increases my cost as a business. And that could then lead to lower profitability. And the very last topic in this revision video that we're going to be taking a look at will be business ethics and CSR. First of all, let's understand what we mean by ethics. Well, essentially, ethics is doing the right thing. It's those principles that govern the behaviour that are morally acceptable. So if a business was to act ethically, they would want to prioritise doing the right thing, even if that doesn't maximise our profit. And when we look at business ethics, it's not just about acting lawfully. It's not just doing what is legally required of you. It's going above and beyond that. Because it's not illegal to go to a developing country to set up your production and take advantage of the fact that the minimum wage there could be less than 50p an hour. It's perfectly legal to do that, but ethically it's not the right thing because you are exploiting their workers' situation. So what are some examples? How can a business become ethical? Well, there's several ones that I can think of here. First of all, you want to treat your employees fairly. Once again, that doesn't mean just paying them barely above minimum wage. It's actually giving them a fair pay and also treating them correctly. So showing that you care for your employees, trying to invest into them. So look at hosting different training for them and focusing on their professional development. We could also look at being environmentally friendly. Now, once again, yes, there is a legal standard that businesses have to follow with the level of pollution. But if you are just barely scraping that level, once again, it's not the most ethical thing to do. So we could start to use more eco-friendly raw materials when making our products. We could look at reducing the amount of waste and how we dispose of our waste as well. Another thing is actually supporting local communities. So potentially making donations, getting involved with different programs. Something that I mentioned earlier as well, avoiding exploitation of workers in poorer countries. Now we'll look at this in a lot more detail across theme 4. But the increased rate of globalization makes it so easy now for a business just to move their production overseas and exploit workers where their minimum wage could be way under 50p an hour. And finally, avoid becoming more of a capital intensive business rather than a labour intensive business. Because yes, your efficiency is going to improve, your unit cost will begin to reduce. But ethically, you're putting those people out of jobs. And the reason why people work, well, the priority is so they can earn money, so they can provide for their families. So if a business was to be acting unethically, what are some of the consequences that they may face? Now, with what we said earlier, ethics is going above and beyond what is legally required. So you may not be facing any legal repercussions, you may not face any fines. However, it will typically negatively impact your brand image and your reputation. Because if it gets out there on social media that the business is acting unethically, they're exploiting workers, and this can then become viral and then customers may be put off by your business. And within that process, you may damage the relationships that you have with some key stakeholders. Customers may start to boycott your business and start shopping from your competitors. You may have employees leaving the business and you may find it more difficult to recruit new employees. Your suppliers and your partners, they may not want to work with you because we've got this concept of brand image transfer. Because if my business is doing bad and I'm working with another company, well then my brand image will be then passed on to them. And overall, your customer loyalty will begin to decrease. However, there is a trade-off between acting ethically and maximising your profits. Because with all of those examples that we mentioned earlier, such as avoiding exploitation of workers in poor working conditions, and not treating our stakeholders fairly, such as our suppliers, Well, if we were to start acting ethically, typically this increases the business costs. We've got factors such as higher wages, more sustainable materials. So the trade-off is, yes, I'm becoming more ethical, but I'm making less profit in the process. However, you could argue that profit could increase if we are acting ethically. Not necessarily from the cost perspective, but maybe we have the ability now to charge premium prices. We also may have more customer loyalty. They may want to shop at our business because they see us as being more ethical. And this could, as we said with the prices, make our customers less sensitive to those changes of prices, making our products more price inelastic. Bit of a keynote there from theme 1. And the very last thing that we now need to do in this revision video is take a look at corporate social responsibility, also known as CSR. Now, CSR has a lot of relation with business ethics, because if we were acting in a CSR manner, we could be saying that we are acting in an ethical way. Because what this would cover is it covers environmental initiatives, ethical practices, philanthropy, so donating and giving back to the community, while still balancing our social impact with financial sustainability. Now, a CSR practices wants to make sure that we are still profitable in the process. But the whole point of this CSR strategy, think we are looking at corporate social responsibility. We want to benefit all of the stakeholders rather than just our shareholders. So it's kind of approaching it more like the stakeholder approach rather than the shareholder approach. And the way we want to do this is by addressing two different factors. Social factors, so once again treating people fairly, and also environmental concerns, so acting in an eco-friendly manner. Now, what is the difference between CSR and ethics? Well, ethics, as we said earlier, is about doing what is right, while CSR is about choosing to make a positive impact on society and the environment. So ethics is about what a business should be doing in terms of their moral obligations, where CSR is about what a business chooses to do to give that voluntary positive impact. They are closely related because CSR is built on ethics. If you found this revision video useful and still want to carry on your theme 3 revision, I highly recommend you check out our video here on theme 3.5 assessing competitiveness, because we're going to go over some key calculations in that session, such as our income statements, our balance sheets. We'll take a look at how we calculate gearing, how we calculate return on capital employed, and we'll also take a look at some important HR performance metrics. I hope this video has helped you with your theme 3 revision. Thank you so much for watching, and I'll see you in the next one.